Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Byrne with your top stories. The US and Iran reach a tentative deal to extend their ceasefire for 60 days, subject to approval from President Trump. A tech rally in Asia and Iran optimism power global stocks to a new record high. Brent crude set for its weakest month in 6 years. And Bloomberg learns that SpaceX has trimmed $200 billion from its valuation target as it prepares to launch next month's blockbuster IPO. Well, a very good morning. 6 a.m. here in London. This is the picture in markets. Global stocks at all-time highs on the US-Iran deal. Asian stocks up more than 2% this morning, and futures pointing higher on both sides of the Atlantic, coming off fresh record highs already on Wall Street. Now, if we flip the board over to the cross-asset picture, as you would expect, given the geopolitics, you've got oil lower by more than 1% as things stand. Brent at $92.58 the barrel. Treasuries up across the curve, yields down 1 basis point on the 10-year at 4.43, and the dollar trading in a narrow range after declining yesterday, and traders really awaiting details of this deal. Now, in terms of the other risk events on the docket for today, at 7:45 a.m. onwards, we're going to get the latest May inflation data across Europe, expected to tick up for France and Italy and hold stable in Spain and Germany. And then we've got loads of central bank speak to bring you today. So from the Fed, we'll hear from Mickey Bowman and Jeffrey Schmidt. And from the ECB, we'll hear from Dimitar Radev and Madis Muller. A busy Friday. Let's set you up for the day ahead. We begin with the US and Iran having reached a tentative deal to extend a ceasefire by 60 days and to begin further nuclear talks with Iran. A source says that President Trump is yet to agree to the terms, however, and Vice President J.D. Vance says the two sides are going back and forth on some of the language points, Tehran appearing to be negotiating in good faith. Let's get more now with Bloomberg's John Herskovits. John, good morning. Tell us just how close really are we to a deal this time?
Yeah, it seems like we're always close to a deal and the deal doesn't materialize. This time we have a lot of positive indications, this memorandum of understanding, as you said, the extension of the ceasefire by 60 days, the language being worked out. So, the signs are there, the markets are taking it positively, but it's a really complex issue. There's so many things that are part of this, but there is this memorandum that both sides are talking about. Whether it actually comes to fruition is another matter. We've been here last week with Marco Rubio saying that perhaps the deal would be a few days away. The deal right around the corner has been there for some time. We may be closer than we've been before, but again, a deal has been elusive.
So we know the sticking points. We've talked about them many times throughout the week. The Strait of Hormuz, the nuclear file, frozen assets, Lebanon. What progress do we seem to have seen on those key sticking points, John, to get to this point?
Yeah, I think that we're looking at possible compromises instead of permanent solutions. For example, like with the Strait of Hormuz, one of the key issues will be like the sequencing of events. How much Iran opens, and that will be met by the U.S. lifting its blockade of Iranian ports. And also demining is something that the U.S. is demanding of Iran, and how the U.S. reciprocates. So there's a lot of trust building that goes on with this. The nuclear issue is really contentious. How it will be worked out is just difficult to say. What will happen to the highly enriched uranium? The disposal of this is something which has been in negotiations. But if there are questions about whether Iran could reconstitute its nuclear program, something that's of great concern. So, there's we can maybe find some things that just get the ball rolling, but the long-term permanent solutions seem to be deferred, and we may have to see these negotiations further down the road. To reach some sort of resolution.
Okay, Bloomberg's John Herskovits. We keep our fingers crossed. Thank you very much. Have a great weekend. And these developments, of course, put Brent on track for its biggest monthly drop since 2020 on the optimism that flows through the Strait of Hormuz may resume. Let's go now to our Asia energy reporter, Stephen Stapczynski, for that perspective. So, Stephen, I do have to wonder what we need to see specifically when it comes to the Strait of Hormuz. for this drop in oil to be sustained? Good morning.
Hi, good morning. I think there are going to be two things. So one on the deal-making side and one on the physical flow side. So on the deal-making side, I mean, clearly if there is language about this opening up, if there is any movement, perhaps if the Trump administration says that they're going to remove their blockade, then maybe we might see some movement by the Iranians to also do the same on their basically de facto blockade. So as long as this 60-day ceasefire continues with some sort of agreement to remove restrictions to the Strait of Hormuz, that would be, I think, key. Now, then after that, the market will be closely watching whether or not you see an increase in shipments, right? A lot of the ships going through Hormuz go through dark. A lot of them are connected to Iran or have connections with countries that have brokered deals with Iran. So, for example, Pakistan was able to get some liquefied natural gas shipments through the Strait of Hormuz because there was a deal between Islamabad and Tehran to let that happen. But if you see less restrictions, so other ships for countries that haven't been making these deals, if you're seeing less ships going dark to go through, and if you see an uptick in traffic, those would all be positive signs. We have seen a bit of an uptick. It goes up and down. Iran says that there was one day recently that was 33 ships that went through Hormuz. That would have been the highest since the war started, but it's still far below where you would have been pre-war, which was 135 ships or more on a daily basis. So that's the big question. How long does it take to get those ships back to those levels? And will ship owners, the crews on the ships, and insurers, will they all be comfortable going through even if there is a extension of the ceasefire?
And then when you factor in the damage to infrastructure that we've seen through this war and the tightness that we've seen in the US market highlighted by the data this week, what's the longer term outlook for the oil market then, Stephen?
I mean, there are some analysts who are saying if things were to go back to normal over the next few weeks, which might still be difficult, you are still facing a tighter potential deficit for the rest of the year, and then that kind of goes away into early next year. But there are a lot of things that do need to change. Some facilities have had to ramp down production. They've been damaged, and not just in oil either. I'm thinking about the world's biggest liquefied natural gas export facility at Ras Laffan in Qatar. 17% of that facility's capacity has been damaged, and Qatar itself said that it would take 3 to 5 years to repair that. So getting back to pre-war levels, yeah, the ships can go through, but there are facilities that either have to come back and resume production, and that can take time. It requires maintenance, or they were damaged and that requires repairs, like you see at the LNG plant in Qatar. So that does mean that even if there is a peace deal, even if there is a resumption of traffic, even if all those things were to happen, it doesn't mean that the oil is flowing and the gas is flowing to the same level that we saw in February.
Okay, so the inflation hangover may yet continue. Stephen, thank you for the update. That's Bloomberg's Stephen Stapczynski. Well, hopes for a US-Iran peace deal are also pushing stocks higher to end the month, with a global stock benchmark hitting a fresh all-time high. Let's go now to Bloomberg MLive strategist David Savage for more. David, it feels like we've been here before. Are these latest headlines going to be able to keep this rally going? Because I'm looking at US futures only flat to the upside this morning.
Good morning. I think that's right. I mean, I think I think the first thing is the AI trade has largely been untethered from geopolitical developments. Incremental moves lower in oil prices have helped, broaden the rally. So if we look here in Asia Pacific, most sectors are higher on the session. A majority of stocks are higher. In a region that's really been driven by a singular theme and a very narrow set of stocks. But if you look at European and U.S. futures, it's a little bit more muted. But overall, I think equity markets and you can see it in front month crude prices, have certainly leaned into the optimism that we are moving towards some sort of agreement. Really, from a market's perspective, the focus is reinstating energy flows through the Strait of Hormuz. So if that's where sort of the priority goes, certainly optimism is picking up. But I think, again, the equity rally has been really leaning on the AI trade. And for the most part, it's been fairly untethered from the geopolitical developments.
I also just want to get your thoughts on the inflation surprise we got out of Japan overnight. Tokyo CPI rising at its slowest pace in 4 years. How does that not derail Bank of Japan hike expectations?
I think at this stage, the Bank of Japan's probably going to look through this single print. I think there's enough evidence that higher oil prices, higher commodity prices are going to continue to push inflation pressures higher moving forward. The policy rate already is very low, and so there's already been concerns that they're behind the curve. And the weaker yen also feeds higher import prices and therefore inflation. And I think there's certainly a risk that a lot of the conflict-related upward pressure on inflation is incoming, right? Shortages in terms of commodity or shortages in terms of fertilizer all will put incremental pressure on food prices and inflation overall. And so markets have started to certainly price a hike in June. But have been unwilling to make that a certainty. I think odds are about 80%. Traders have been left disappointed before, but I think it's going to be hard for them to walk that back at this stage.
Okay, David Savage, Bloomberg MLive strategist, thank you very much. And we're going to continue the central bank's conversation later on in the programme. Ankita Amajuri from Pantheon Macroeconomics is going to join us, and we'll talk about the supply shocks in Europe. We'll wait for the latest inflation data and really whether a US-Iran peace deal should derail a June hike from the ECB, as the market's expecting, will be on the table. But first, we'll talk tech. Rising demand for artificial intelligence servers seeing Dell soar after releasing its annual sales outlook. So that's next. This is Bloomberg. Dramatic scenes from a Florida launch pad where Blue Origin's New Glenn rocket exploded in a massive fireball while undergoing a test. It's a major setback to the firm backed by Jeff Bezos and its effort to challenge a dominant SpaceX. Blue Origin said that the rocket experienced a, quote, anomaly during the test, adding that all personnel have been accounted for and are safe. Well, let's speak now to our Bloomberg Global Defence editor, Jerry Doyle, for more. So, Jerry, we've been looking at this footage of the blast. What more do we know?
Well, at this point, it's still not clear exactly what caused the explosion. It was on the pad for a static fire test, which is what we call a test of a rocket's engine without it leaving the pad. Something went wrong down there. The rocket was fully fueled. Something sparked the fuel, and the result was a huge explosion. Now, because the explosion was so violent, it will probably take some time to determine what the technical reason for the blast was, but after that investigation, you can expect that Blue Origin will do its best to put those lessons to good use and try to make sure something this dramatic doesn't happen again.
Well, of course, it comes as Bloomberg understands that SpaceX is lowering its IPO price. Jerry, does that mean that the Blue Origin explosion would have an impact on the rivalry between the two companies?
I mean, it could. Both of them are vying for U.S. government contracts. Obviously, SpaceX already puts a lot of national security payloads in orbit. They're both companies that are very involved with the Artemis moon exploration program. Blue Origin and contract to land NASA rovers on the moon. It was preparing to take up some satellites for Amazon.com for a rival satellite network to SpaceX Starlink. So you can see the parallels, the levels of competition here. And certainly, with SpaceX having a very high launch tempo with its Falcon rockets already, Blue Origin being forced to maybe settle things down and figure out what went wrong before they try another launch, it could give SpaceX an advantage.
OK, Bloomberg's Global Defence editor, Jerry Doyle, thank you very much. Well, coming up on the programme, we'll bring you some of our interview with Alberto Masalem, the St. Louis Fed president, of course. That's next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, 6:19 a.m. here in London. Staying with tech, Dell shares soaring almost 40% in late trade after its full-year sales outlook far surpassed analyst estimates, fueled by demand for servers that power the AI work. Now, the hardware maker sees fiscal year revenue reaching about $167 billion, including $60 billion from AI servers. Let's get some analysis now. We can break down the numbers with Bloomberg senior strategist Neil Campling. Neil, what should we make of these results then? Put them in context for us.
Yeah, well, I mean, obviously the stock has had a huge run already, 150% into the this year, into the close before the massive price reaction after hours. I think what really stood out, Lizzie, was the fact that they raised guidance by like 35% on the top line versus consensus, and that's for the fiscal year. And why that stands out so much is this was only the fiscal first quarter. So the fact that they are delivering across the board numbers that was simply way above street expectations, as we can see on the screen, that EBITDA was 45% above street estimates, revenues above the consensus by over 20%, and then to raise the guidance substantially above consensus, even greater than that, suggesting acceleration of growth. The demand for AI servers, it literally finds no way of denting the appetite there. It's just really, I think, that we're so early in the fiscal year that they guide so far above the street tells you there is a huge demand for this, just like we had from their rival Lenovo out of Hong Kong earlier this month.
And meanwhile, you've got Apollo and Blackstone said to be working on a debt financing deal to help Anthropic build out its AI infrastructure. How significant is it in terms of private credit and also chip financing coming together?
Yeah, I think what we've already seen, obviously, in the public equity markets, a huge surge in a lot of the related AI baskets and thematics and stocks. But it seeped obviously into the private credit space, into other assets where really everyone kind of wants a piece of the AI exposure and opportunity. And clearly, this particular deal again is showing us that there is high financing needs to build out these ecosystems, and massive bets are being made on who potentially could be the winners in this particular AI race. But in terms of when we're looking at paybacks and opportunities, when we're looking at things like data center build-outs, these are multi-year, multi-decade opportunities. Hence the attraction for the debt offerings and the appetite to get involved, I think.
And this is a new funding round seen Anthropic eclipsing OpenAI's value for the first time. I feel like your job on Daybreak Europe, Neil, has become putting things into context for us, telling us who's the bigger fish and by how much. Do you want to just do that again in the case of these two companies?
Yeah, sure, Lizzie. I think the background here is that the founders of Anthropic have come out of OpenAI. And we heard earlier through Bloomberg exclusives earlier this month that Anthropic's revenue run rate in Q2 was far greater than OpenAI's revenue run rate in Q1 that we had the data for. So it's a sense that Anthropic's potential market cap now in terms of the funding rounds is greater than OpenAI. So sort of being born out of OpenAI in one sense kind of tells you just how big Anthropic has become. And Anthropic with Claude is really, I suppose, the business case opportunities for AI, whereas perhaps so far what we've seen is a lot of the OpenAI ecosystem is more for consumers, for us to use on an everyday basis, whereas where people or investors are concerned about the impact of AI in the workplace, it's really by using Claude and the agentic AI toolsets, of which Anthropic does appear to be the best in class today, in terms of offering solutions rather than using sort of software as a service or the other stacks that are out there. So this kind of validates, I think, the positioning of Anthropic as today the leader in the AI ecosystems. But as we know in technology, things can change very fast. So the race is not run. There's not a definitive answer as to who wins out. But for now, sort of Anthropic is certainly leading the charge. And it's the growth rates have been absolutely stunning in terms of the last year or so for the business. And remember, Anthropic had no product less than 3 years ago. So simply is stunning.
Yeah, striking, really striking. Neil, thank you very much for the analysis, the context this morning. As ever, Bloomberg senior strategist Neil Campling out of Brighton. So I hope you enjoy the beach this weekend, Neil. Well, turning to the macro now, the St. Louis Fed president says that policymakers need to be open to the possibility of a rate hike, given the current economic backdrop. Alberto Masalem told us that he agrees with Fed officials who wanted to drop the easing bias from the April statement.
Their real policy rate right now is running at around 0.5%, which is lower than the 1% that the committee believes is the neutral rate. I think you have to look at the full picture, and it looks to me like policy is at or slightly below the committee's long-run neutral level.
But if you combine that with the other things you talk about, you had emphasized the risks of the inflationary pressures on the demand side and the supply side of the economy. It sounds like you think they should be leaning towards tightening. It sounds like you might have been one of the policymakers in the April meeting who actually thought they should have removed the statement against tightening in the statement.
So yes, I supported the interest rate decision, but I thought the easing bias was no longer consistent with the outlook and the balance of risks, which in my mind, the balance of risk has shifted a little bit towards the inflation side and less towards the employment side. So whether the economy will require a hike or a cut or a hold will depend on the scenario. There is a scenario where inflation remains high. There's no disinflation in the next quarter or two. And in that scenario, the economy will probably require a hike. There's also a scenario where the economy weakens materially in the second half of the year because real incomes are challenged and corporate margins are challenged. In that scenario, inflation could come down. In that scenario, we would be thinking of no hikes, maybe even a cut. So there are two scenarios to play with here.
But looking down the track, at least the markets are now fully pricing a rate hike by March 2027. Given where we are now, how we think things are going to proceed with oil prices and some of the risks on the supply side that you talk about, do you think that's a sensible thing for them to price?
Again, I think there are two scenarios here, and I don't comment normally on market pricing. I'm more focused on what's best for the economy and for Main Street. Markets have repriced materially in the U.S. and in other countries in the front end of the curve. I think that's markets trying to understand what our reaction function is.
The St. Louis Fed President Alberto Masalem speaking to Bloomberg's Stephanie Flanders there at the Reykjavik Economic Conference. Well, let's check in on these markets. 6:27 a.m. here in London, and we are looking at stocks globally at all-time highs on the hopes of a truce renewal between the US and Iran. Asian stocks have been higher, and that is boosted by oil. You can see it here. Brent lower at $92.67 a barrel, down 1.1% now on the optimism that flows through the Strait of Hormuz can resume. And in fact, Brent on track for its worst month since 2020. We're down 18% since May. Treasuries up across the curve. The 10-year there at 4.43, and the dollar trading in a narrow range. Coming up, though, we shall turn to economics and we'll discuss the euro area and the UK with Ankita Amajuri from Pantheon Macroeconomics. So that conversation coming up next. Good morning from London. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. The US and Iran reach a tentative deal to extend their ceasefire for 60 days, subject to approval from President Trump. Meanwhile, a tech rally in Asia and the Iran optimism have powered global stocks to a new record high. Brent crude set for its weakest month in 6 years. And Bloomberg learns that SpaceX has trimmed $200 billion from its valuation target as it prepares to launch next month's blockbuster IPO. Well, a very good morning. Welcome to the show. if you're just joining us. 6:30 a.m. here in London, and this is the picture in markets this happy Friday. We've got Asian stocks up, European futures higher, and coming off record highs on Wall Street, futures flat to the upside there as well. All on this optimism that we are close to a US-Iran deal to extend their ceasefire by 60 days, pending President Trump's sign-off. And you've also got tech boosting stocks in Asia as well. Now, flip the board cross-asset, and you can see what's boosting sentiment. Really, it's the fact that oil is lower, more than 1% for Brent now at $92.66 a barrel. Yields are lower across the Treasury curve. We're down a basis point at 444 on the 10-year. And gold has been holding on to its gains. We're around $4,500 an ounce as the hopes for a deal ease inflation fears. Let's see if we can get it over the line. Time now, though, for our front page news. We'll start off with the Financial Times, shall we, this morning. They, of course, as you'd expect, are leading on the hopes of that US-Iran peace deal. An administration official saying that the two sides have reached this memorandum of understanding, but President Trump yet to approve the document. We also have the Wall Street Journal this morning, but they're focusing on its own reporting that real estate agents are quitting the slow US housing market, saying that experienced professionals have reached their breaking point. And if we come to Europe now, we can look at Italy's Corriere della Sera. They're leading with Blue Origin and a headline describing the explosion of one of its rockets during the Launchpad tests, as we were watching earlier. Really dramatic scenes. You can get a roundup of all the stories you need to know to get your day going in today's edition of the Daybreak newsletter, which, as always, terminal subscribers can find by going to DAYB Go. Well, let's turn to the data that we're due today. Fresh inflation data from Germany, France, Spain and Italy expected to provide further evidence of the mounting price pressures across the euro area, driven largely by that surge in energy costs following the war in Iran. Now, the figures come just days before the ECB's next policy meeting, widely expected to hike rates, and we've also just had the minutes of the last one. So let's break it all down. We can talk to Jana Randau out of Frankfurt. Jana, good morning to you. Just talk us through what we should expect from the inflation data and where it would leave the ECB.
Good morning, Lizzie. Yes, so a big day for the ECB, for the Eurozone, for everybody who is watching over inflation trends. And as you mentioned, we will get data from all of the region's 4 largest economies this morning. It doesn't happen too often that all of them come out on the same day, but the message will be one that filters across the region. We expect pickups in all of those except for Germany. There's a small slowdown in the cards there, but even then, that rate is still expected to be at 2.8%. So quite a bit above what the ECB considers optimal, the 2% target. Now, what will be interesting is to see whether whether that is only confined to energy, or whether the core rate, those that the one that strips out volatile items, energy for sure, food as well, whether that picks up, because that will go a long way to assessing underlying price pressures across the region, and that will be important to the ECB. I do want to mention that we will get also a little bit of a signal from some countries over the health of the economy itself. So consumer spending in France, for example, is expected to have declined in April. Italian unemployment probably went up. So a big day for everybody who's interested in what the Eurozone economy has been up to lately.
Who is not interested in that, Jana? But interesting as we look ahead to June, looking back to April, that a number of officials wouldn't have opposed a hike even then.
Yeah, I mean, we knew that a hike was on the table. The president mentioned it when she briefed reporters after the April decision. But what we learned yesterday, that it might have been a little closer than we thought. That people said, and a number of them actually said it was a close call, and people would not have objected a hike. They weren't quite ready to propose it themselves. That is the job of the chief economist, Philip Lane, but they wouldn't have objected had he done so. And that tells you a little bit about the uncertainty, about what's happening, how difficult it is to make a decision. And of course, the June one is coming up, and we're hearing from all corners that a hike then is pretty much inevitable. The hawks are saying, saying it outright. Philip Lane, the chief economist, has signaled it without using exactly the same words. And even some of the doves that I had a chance to speak to over the last couple of days, they said, look, a hike comes at a cost to the economy. I wish we didn't have to do it. But we're still probably going to have to face it, if only to preserve the credibility of the ECB, because their inflation in the Eurozone running at 3% already, expected to pick up. Data next week will show that. So yeah, really not much of a choice for the policymakers, and we'll see the first building block, if you want, for their arguments that they will make in 2 weeks' time this morning.
Jana, thank you very much. That's Bloomberg's Jana Randau across all the thinking behind the scenes of the Governing Council. Well, for more analysis, let's now bring in Ankita Amajuri, Europe economist over at Pantheon Macroeconomics. Really good to have you with me on set this morning. So we've got this new development, potentially a truce between the US and Iran, an extension of the 60-day ceasefire. Is it already too late to stop the ECB hiking in June and maybe follow-up hikes later in the year?
So we remain of the view that the ECB will still hike in June, mainly because even this peace deal, if it goes through, it does not change the outlook for inflation materially. Oil prices are significantly higher than where they were at the start of the year. And perhaps rather than 3%, we might have a 0.1 percentage point lower forecast based on the latest changes. But ultimately, for now, we are expecting 2 rate hikes, the first one in June. We also think it'll be followed up by a second one in July. However, once inflation has been brought down a bit, we expect the bank to cut rates soon after, early next year.
But is the ECB not at risk of tightening into a growth slowdown that hasn't fully revealed itself yet?
There is that risk, like your colleague Jana just mentioned. There is a risk to growth, which for now we are not seeing a significant slowdown in growth just yet. However, we're coming, this inflation shock now comes at a time just shortly after the previous one. And perhaps inflation is the more pressing issue for the central bank right now. Firms already have this inertia of raising prices in the post-pandemic inflation surge. So we think the bank will ultimately choose to respond by hiking rates, sacrificing growth to a certain extent, but wanting to maintain its credibility on the inflation front.
Well, in terms of that inflation issue then, how much is Germany's fuel tax cut masking a broader inflation problem at this point?
So part of the reason we're expecting a slight decrease this month is because of the cuts to energy taxes. But overall, we still think that even in Germany, there will be second-round effects over the next few months, resulting from the surge in oil prices.
OK. Let's also talk about the Bank of England. Is the market expecting too many hikes this year from the BOE? 2 is what's priced.
In my view, 2 is too many. We are expecting 1, which is in July. And even then, it is a close call because the labour market in the UK is weakening and the risks to growth in the UK are a bit higher. We saw as well that the April inflation data was a little bit weaker than expected. Part of that was because of cuts to energy prices that were part of the autumn budget. And there were also, let's say, one-off effects on airline ticket prices, etc. Those will unwind over the coming months. We do expect inflation to rise a bit further. But given the significantly weaker labour market here in the UK, we think perhaps markets are pricing in too many rate hikes.
But does it not damage the BOE's credibility to only go for 1, if that's what happens, according to your forecast, when they sounded so hawkish a few months ago?
Well, on that front, the BOE, the Bank of England, has not hit its inflation target for a long time now. Whether that does significant damage to its credibility is it is an interesting question. But here in the UK, I would say it's again a story of the weaker labour market, and perhaps that will take more precedence over inflation.
Just finally, we've got to talk about the politics. I wonder if you buy Andy Burnham's pledge, this is of course the Greater Manchester Mayor, to stick to Chancellor Rachel Reeves's fiscal rules if he were to become the next Prime Minister, replacing Keir Starmer. Because we've seen yields falling, but should the bond market really be encouraged by this?
At the moment, we think that perhaps 20 basis points in gilt yields is a risk premium related to the ongoing political uncertainty. A lot of the policy stances from Mayor Andy Burnham, or former Mayor Andy Burnham, will require more spending. Whether that comes in the form of higher taxes or more borrowing remains to be seen. But overall, we think it will add a couple of basis points more to gilt yields. And ultimately, it is, we do think he is likely to stick to the fiscal rules and perhaps might not even have another option if bond markets don't allow for greater flexibility around that.
Yeah. But they'll keep him in a straitjacket where he might need to pull some uncomfortable levers, whether that's borrowing or higher taxes. Ankita, really great to have you with us in the studio for the first time on Daybreak Europe. Ankita Amajuri, thank you, Europe economist over at Pantheon Macroeconomics. Well, coming up on the programme, why SpaceX is said to be cutting $200 billion from its valuation target as Elon Musk's company nears its debut. More on our scoop next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Just coming up to 6:45 a.m. here in London, and Bloomberg has learned that SpaceX is lowering its targeted IPO valuation to at least $1.8 trillion. Elon Musk's company is seeking to raise as much as $75 billion, which would make it the biggest IPO of all time. Let's now get more on this scoop with Matt Bloxham from Bloomberg Intelligence. So, Matt, sources had told us earlier that it was aiming for a valuation above $2 trillion. Mm-hmm. Why are they given a discount now? Is this always been built in, do you think?
Probably, and I think, pricing an IPO is always a bit of a dark art, and it could well get back up above $2 trillion, through the process. Let's wait and see. And obviously, what the bankers are trying to balance here is giving a big enough valuation so the company gets good value in terms of how much money it raises, but also leaving enough on the table so that investors that take part actually see a kind of flotation day pop, and so they feel like it's been a success. And so balancing those two things can be quite tricky. But obviously, the roadshow hasn't started. They've got some initial feedback from investors, but they'll get a lot more through that process, which could start next week, and that will narrow the pricing range down. But these are big valuation multiples. I mean, a $2 trillion valuation would imply about 100 times trailing sales. That's massive. Now, Rocket Lab, one of their direct space rocket peers, trades on a similar multiple, but then if you look at something like Anthropic, that seems like it's trading on about 20 times forward sales. So there are lots of different valuation multiples and benchmarks here, and it's going to be quite interesting to see where investors put the weighting. Yeah,
it feels like we're entering a new era when it comes to all these IPOs. We've been talking a lot about the rocket side of things, but what could Musk's XAI business mean for the IPO?
Yeah, so I mean, I think you kind of have to look at this. It's an incredibly complex business now, and XAI, is growing at an incredibly rapid rate. Could go from a $1 billion kind of annual revenue run rate to about 20 billion or more in a couple of years, based on our own calculations. A lot of that is coming from this Anthropic deal they signed. Anthropic using them for AI compute capacity, and also the potential acquisition of Cursor, which is the kind of leading agentic AI business. But kind of rapid growth there, and so suddenly the AI elements of the business could quickly dwarf things like the rocket business and the Starlink broadband business in terms of sales.
Okay, really interesting. But we also know that SpaceX could be facing a US government review over its defence contracts. Could that impact the IPO?
I think it's unlikely to. I think, certainly there could be a deep investigation here of, the kind of national security interest given their exposure, particularly to NASA. I think the reality is that there'll probably be mitigating factors that SpaceX agrees to kind of give assurances about the kind of the secrecy issue and the influence of foreign investors in the business. A couple of things here. A, SpaceX has been working with the US agencies for a long time, so there's, I think, a strong degree of trust between the two sides there. The second is actually it's Elon Musk that they need to be comfortable with, because he's going to own 85% of the voting rights in this business. So it's almost a kind of derivative. Who is influencing Elon Musk, because he's the one that ultimately is calling the shots at SpaceX and will continue to for the future. And so he's the person that they really need to be confident that they can trust.
And of course, we know his relationship with Donald Trump over the years has been rocky, to say the least. Matt, thank you very much. That's Matt Bloxham from Bloomberg Intelligence. Well, it's a Bloomberg Intelligence double-header today, because we also have BI reporting that the UK could miss its goal of adding 1.5 million new homes in the current parliamentary term by at least 40%. Their study says that the government needs to ramp up efforts to stimulate demand and help developers. And Ivona Hovenko from Bloomberg Intelligence is with us now for more on this. So thank you also for joining us, Ivona. Your analysis then suggests that annual housing construction in 2026 to 2029 would need to rise 40 to 50% above current projections to meet the government's 1.5 million homes target. It was always seen as massively ambitious, this target. So what explains such a large gap then?
Well, the market was never geared for that kind of level of construction. And just to put it in context, that level of housing construction has not been reached since the 70s. Yeah. And this was actually driven by the big social and public housing construction program, as well as actually a big involvement of SME home builders. What's happening right now is that government has been trying to stimulate supply. However, for years now, new housing has been actually lagging the pre-COVID levels, and it's not going to recover anytime soon, especially as the backdrop weakens, confidence is weak, rates are high, we have another cost of living crisis. So the backdrop is extremely unsupportive, and on top of that, we have another spike in construction costs coming. So just simply, the maths don't work.
And of course, all of this is the sort of thing that the contenders to potentially replace Keir Starmer will be thinking about, not just from Labour, but from other parties as well. When it comes to policy, though, you argue that buyer support may be needed, something maybe like Help to Buy. Wouldn't that just risk pushing house prices higher, which has been such a problem over the years?
Yes, there is the risk of that. However, the previous Help to Buy ended just as the rates were spiking. So I'm arguing that there is no single silver bullet. We need a different variety of measures, also supply side. And a new Help to Buy also needs to be really well targeted at the marginal buyers. The previous Help to Buy was faced a lot of criticism for supporting buyers who never actually needed it.
But you have the bank of mum and dad.
Well, yes, but not everybody has that, and also even those mums and dads are squeezed. They have to think about their own retirements, etc. So we need supply side support as well. But home builders, won't start new projects if if they're not selling right now. They usually match those sales rates to new starts to sales rates. So this really is a function of.
So if I give you a menu of some of the potential policy levers that a new PM could pull, what would make the biggest difference? Stamp duty reform, public housing investment, cutting regulation, as you say, helping smaller developers. What would make the biggest difference?
And again, I would here say there is no silver bullet, and several of those measures require time, money, or both. And there is no money, as we are well aware. So I think, stamp duty has been a very toxic tax, but it's the residential side of it generates £10 billion a year. So the government cannot afford to scrap it, but maybe some reform could be supportive. I would say the easiest levers right now are in the regulation space, because they could potentially deliver the fastest and they might not cost the government very much. A long time ago, one of the home builders said, in terms of the affordable housing requirements, for example, and if you raise those targets too high and the projects are not viable, you will just get 100% of nothing.
But you do wonder why this hasn't happened yet from Labour when they said they'd be the builders, not the blockers. But really good to get this research from you. Thank you so much for flagging it to us.
Thank you very much.
Ivana Havenko from Bloomberg Intelligence. Well, we've still got plenty more coming up, so don't go anywhere. This is Bloomberg.
Our mandate is price stability and maximum employment, and right now we're above target on inflation, and so the possibility or probability that we might consider an interest rate increase in the future, I think, has to be greater than zero.
A little more from the St. Louis Fed President Alberto Mosalem. They're decidedly hawkish in his tone. But let's look at the data, shall we? We've, of course, got US PCE data yesterday, the preferred inflation gauge for the Federal Reserve. And what we saw was the continued squeeze on the US consumer, given all of the inflation pressures from the Iran war. So struggling to pare back purchases of household goods, to pay for gas bills. And there you've seen personal savings dropping and personal income back to zero. Income in the blue line, savings here in the white. Now, flip the board because we may be in for some good news. It looks like we're on the precipice of a deal to extend the ceasefire between the US and Iran for another 60 days. Trump still needs to sign off on this, but of course it would be a relief for consumers. And so in anticipation, in terms of the stock picture, we've seen this rotation into consumer discretionary stocks, in fact, surpassing tech stocks here in the blue line, and maybe we will see that continue. One to watch, though we have heard from the Vice President, J.D. Vance, saying that this deal is still TBD. So we shall be across all of the developments right here for you on Bloomberg TV. You can get these charts at CHRT TV Go. But Jemana Basecci and Tom McKenzie will be taking you all the way to the European Cash Open next. And we'll have an exclusive with Andrew Bailey, the BOE governor, later today. Stay with us. This is Bloomberg.